hard way, and then had some big wins. And I always say the markets you either humble in the markets or they humble you. So.
Right. Yeah, that's true. And that's one of the reasons why I like to get people like you on this show, because you've got a professional experience, but then you went off and to do it on your own, and then you started your own company. But most of the people that are listening to this show, they don't have that professional experience. And so it's really good to get your take and get your viewpoints on just for the average guy. So
Absolutely.
based off of that, what do you think are some of the key things that the just a regular retail trader should be looking for to help give them an edge in today's markets?
Yeah, I think that's an amazing question, and it took me some years to figure that out at Morgan Stanley. But I would say go where you know something already, right? So you have a career, you have an educational background, whether it's in you could come out of a sales background, you could come out of a certain specific industry like oil and gas. If I have that knowledge and that experience, that's where I'm going to look for investments first, because you have an edge that you probably take for granted just because you've done that career or that hobby for so long. You know more about it. One of my great trades, but I lived in the Southeast for a long time. Costa sunglasses were a huge hit down in the Southeast. It was regional. All my buddies fished and were on boats. That was something I could see in the markets that no one else saw yet, because it was a trend that, I was on the ground before it bubbled up to New York and Wall Street. So I'd say look where you know. I mean, it's a famous Peter Lynch, right? Like go where you know, or where you see your kids are talking about things. You have an experience there that gives you an edge, that you notice things before other people will. And that translates into profits very often in the markets.
I actually like to do that myself. I run a lot of screens for stocks, and I'm looking for certain criteria for it to happen on a daily basis. And usually when I'm looking at my daily screen list, the stocks that I always look at first are ones that I know, or
Yeah.
something like, for example, one popped up yesterday. It was Turtle Beach, and
Oh yeah, absolutely.
they do audio equipment, and my kids are into gaming, so I've purchased a ton of headsets
Yeah.
from Turtle Beach, and I'm like, okay, I know these guys are making money. Then you do some research on them, but yeah, that's good advice.
No, it's a great company. Jurgen Stark is the CEO there. I know him from his previous job at Parametric Sound. But the other thing too, I'd tell people, I always used to, when I had a losing trade or a winning trade, even I'd take the ticker off my screen because I didn't want to see it again. It was kind of that whole, if it was a losing trade, didn't want to think about it, and if it was a winning trade, didn't want to, jinx it by going back to it. But now in my career, I think you got to keep all those tickers on your screens, because the longer you follow them, like Turtle Beach, I followed that company for 7 or 8 years, and like it presents trading opportunities when you still pay attention to them, when you know the company in and out. And it may be a couple years in between trades, but keeping them on the screens is always a great idea.
Yeah, and I know that I don't like looking at trades when I lose either, because it stinks. But sometimes the more you look at it and you analyze where you went wrong, the more you can learn from it. And sometimes your biggest problems are also opportunities. So
Agreed.
with that mindset being forward, what are some things that you've learned in trading from some of your difficult times?
Yeah, I think you always have to have a catalyst, right? So I think early on, I focused mostly on tech and new technology, and I came from a fundamental background. So I had to study at Morgan Stanley every type of company, from emerging market companies, international companies, large cap, small cap. And the thing that stands out is, especially if you're more of a trader and not longer term investor, is you've got to have something on the near term horizon that's going to move shares, whether it's an earnings report, a new product launch, some other catalyst. Otherwise, you're just sitting around and waiting. And, it could be a great setup, a good trend. But if there's not something that's going to catalyze more buying in the stock, you end up, it's a big opportunity cost. You end up sitting there and not making any money. And then you get frustrated and second guess yourself. And, then you tend to sell a little bit early. So I'm always looking for some catalyst within 30 to 45 days of entering a position. And then obviously you want some more catalyst behind that, because things in business get delayed. Things in the real world get delayed. So you have to just take that into account. So yeah, that's, I think, one of my number one things is make sure there's a near-term catalyst and then catalyst behind that too, that, are kind of contingency plans.
So when you were talking about finding a catalyst and looking for something to drive it within 45 days, the first thing that popped into my mind is, oh, well, how long is he holding these trades for? So do you have a timeline, or are you just going to hold for as long as you think it's going to continue to move up?
Yeah, I mean, look, I look for tax efficiency. So ideally, I want to hold everything for at least 366 days. But the reality is, things move quick. I mean, especially in small and micro cap land. I mean, there's times where I've had stocks go from $2 to $22 in 30 days, and at that point, that's a good tax problem to have. So, I think what I'm looking for is an initial hold period. If that catalyst comes to fruition and the stock moves, I'm going to take some profits off the table at that point on that first move up. It's kind of rule of thumb for me has always been at, when the position's almost doubled in price or right around that point, I'll take my original capital off the table, let the winnings ride. And then as long as the company keeps doing what I expected it or the trend keeps playing out, I'll hold that position, for as long as it lasts. And then, exits are different. I know some people use trailing stops and some it's just a profit target. I think that's more art than science. I think for people that are always, they find, you got to learn what works for you. I've found that once I'm up a certain percentage that I'll put on a 25% trailing stop and just let that kind of play it out. But other people, I run a smaller portfolio. So another time I'll exit because I have a new opportunity and it's like, okay, well, I need capital. I have limited capital. I got to move it from one into the next. So, those decisions all come into play.
Yeah, there's opportunity costs because if you're holding something and it might be a good trade, there's the opportunity cost of putting your money into something else that could have a catalyst moving forward. And I find that to be a balancing act, and I'm one that I don't always have the answer to because, I could move some money from one thing into another, and right. It might end up working, it might not. So I think when I was looking at your products, and I noticed you were talking a lot about asset allocation and portfolio allocation. So I think that's kind of a good part of this where you decide where you put your money in. Can you talk about that a little bit?
Yeah, sure. So I mean, mine, I can't give personalized investment advice, but I can tell everyone what I do and how I've come around that. So I started with Morgan Stanley, and that's all we did. I mean, we did asset allocation studies for huge endowments, diversified them across every asset class imaginable, from large and small caps to international to hedge funds. And what I've come down to is really we don't have much of an edge unless we get into like small and micro cap stocks. So everything else, I think you can very easily kind of set it and forget it with low cost ETFs. So you asset allocate. For me, it's about 60 to 70% of my portfolio is asset allocated into low cost ETFs. I'll tactically change that from time to time, but then it's the other 30 to 40% where I'll put in more risky speculative investments. So I like to think about it as the 60 to 70%, make sure I get to retire and meet my goals. The 30 to 40% determines what quality of retirement that is. And, it's a bit more speculative. I'm taking more risk. Some people do 80-20, right? So asset allocate with 80% and then go speculate with 20%. And I've found that over time that tends to be just, a manageable amount. 20 to 30%. At any given time, I'm probably in 10 positions max. I think it gets hard when you're trying to follow, 20, 30, 40 different small investments. I also think you water down your returns, right? If you hit a big winner and it's only, 1% of the portfolio, it doesn't make that much of a difference. But if it's 3 or 4%, it can change. It can have a meaningful impact.
Right, especially if you get a really nice return on one of them, where you're like you said, where it goes from 3 to 22.
Yeah.
You put a decent amount in that. That's pretty good.
Yeah, no, those are the good days in the market.
yeah, and you'll have your good and your bad, as you know.
Absolutely.
So I'm really excited to have you on right now, just because it seems like you've been everywhere recently. I've been watching a lot of videos online with you and Rob Booker, and you guys are traveling around in a DeLorean, and you got $500. And tell us a little bit about what all that is and what's
Rob
going on right now.
Rob and I have just connected, and we, there's always opportunity in crisis, right? So that was the genesis of it. We noticed with the pandemic hitting that, most people freaked out in the markets. I mean, if you can remember back to February, March, it was just it was just off the cliff. Everyone freaked out. I salivate when opportunities like that happen. I mean, it's scary as hell. Don't get me wrong. My portfolio took a hit too, but when you have cash available, you can take a very small amount of cash in those moments and turn it into a lot more if you know where to look. So Rob and I got together, and we basically are, demonstrating how a small amount of money can change your financial future if you know where to invest it in those moments. And it wasn't just the pandemic. I mean, if we go back to 2008, 2009, there's many crises all the time in the markets, and it's knowing how to control your emotions and then use that to your advantage is really the point of us getting together. And so the DeLorean was just, look, it's a classic movie going back to the future. And, he's like, hey, why don't we buy a DeLorean? I'm like, yes, that's just for the opportunity to drive around it. And we were in Houston. Apparently there's a guy in Houston that bought all the rights to DeLorean. So it's like an epicenter of DeLoreans, like driving around in Houston. So it was cool.
Yeah, that is pretty cool. So if I can understand, because it took me a while to try to figure out what you guys were talking about, but now I'm getting a better picture. So basically you're saying that after these massive events in the markets, like the 1987 crash, the 2000 tech bubble, 2001 drop, 2008, the current pandemic, you're saying after these things happen, there becomes an investing opportunity?
It's a huge opportunity. And what happens is, everyone focuses on the sell-off, but what they don't realize is because a lot of people's knee-jerk reaction is to get out of the markets. And then they have to ultimately decide when to get back in. And what happens is everyone waits and waits and waits. What happens though, time and time again, is you see a snapback rally really quickly. So if anyone pulls up the ETF for the biotech index, the IBB, or the semiconductor index, like you look what happened in the sell-off in March, very quickly after that, it got, the biotech index was back to its old highs and then hitting out to new highs. And that was right in the teeth of the pandemic, like right when cases were spiking, when it was just nothing but just fear in the headlines. And if you can look past that, there's these massive rallies that happen in the moment. And, I think the majority of investors kind of get shell shocked and they sit on the sidelines. And that's exactly what we're trying to convince people to do the opposite of. Don't do that, because that's where a great amount of money can be made, with not much risk. You can just put a little into the market at that time and make a lot of money from it.
Now, like you'd said, there's a lot of fear. The prices are dropping. It can be a little scary. But my question is, you don't really know for sure that something's going to bounce or that it's going to recover, because we have seen really substantial bear markets in history, not so much in the United States, but in other countries where there's been total economic collapse. We don't really know. In that case, there's not much you can do anyways. But how do you protect yourself, and how do you time it so that you know right when the right time to get back in is?
Yeah, I mean, I look at it as it's two things. Earlier, I said invest in what you know, right? So I make sure that if I'm putting new money to work, it's in things that I know, businesses that aren't going to go away, whatever the macro event is. So, for instance, I like to call them forever growth trends, right? These are tech trends that are going to persist no matter what happens in the economy. Like the classic example is smartphone usage, right? Smartphones came on the scene in 2007 with the iPhone launch. We went through a nasty, market, and did smartphone usage change? No, it didn't stop. It actually kept accelerating. So in this current pandemic, there was a lot of companies I knew in the biotech space, and that's, people aren't going to stop getting type 1 diabetes. So one of the companies that I knew really well has a drug that could prolong the onset or completely cure type 1 diabetes, prevent it from happening. That's not going to change. The prospect for that company is not going to change no matter what's going on in the macro environment. So I think it's really, as a retail investor, you have to think about what are companies that I can put money into that whatever's going on in the market is not going to impact them. So, classic examples of places not to put your money right away would have been in restaurants and airlines. We knew a pandemic was going to have a negative effect on those businesses. Did they bounce? Yes, but that's a risky bet, right? That's a risky rally.
Right, because they're still in trouble even now.
Right. So it's, you got to look past that. You look at what are companies that benefit from actually what the macro environment was. And that was things like Zoom, the video conferencing, which I think that stock got ridiculously ahead of itself, but people were right. Like, hey, there's going to be a lot more people using Zoom. And I think their user base went from like 30 or 40 million to 300 million. So that happened. Telehealth, right? That became a huge thing because no one could go to the doctor really because they were, or to the hospital. So I think you have to, in the moment, it's situational. I can't say there's a hard and fast rule that, hey, when the market sells off, every time buy this. The one thing I would say that might fit that bill is semiconductors. Right. I look at the world and, everyone talks about the Internet of Things. I look at it as the Internet of Chips, because that's really what we're doing, right? Chips are becoming smaller and smaller. We're putting sensors in everything imaginable. If you look at chip demand over the years, we hit 1 trillion units shipped in 2018, and it's going to 2 trillion. That's one of those you can faithfully buy the dip in the semiconductor index. There's a company, NXPI, I think is a great kind of one-stop play on every big tech trend in the chip space. That one has been, any dip below 100, I've always bought on that because it's just, it's a short-term drop in demand, and then longer term, those trends are all going to persist.
This has been some very insightful information and tips that we can use on managing our portfolio and helping us take advantage of some key market conditions like the pandemic. And so we just got to be ready for those in the future. So thank you for that. My next question is in regards to the current promotions that we're seeing all over the internet right now, lots of emails and traffic I'm seeing going to it. Tell us a little bit about what that specific product is and what it does for investors.
Yeah, so that product is a Microcap research service. So I've been an independent analyst for the last 15 years, and that means I invest in everything I write about, right? So that makes me different. A lot of the guys, even on Wall Street analysts, the sell side guys, they write about companies they don't have any skin in the game. So I've found through all the years that the best edge that we can get is in the microcap space. It's where information is slow to get to the market sometimes. If we're willing to roll up our sleeves and do the digging, we can really get an edge there. So this product focuses on undervalued, undiscovered microcap stocks that have a catalyst like I said, in the next 30 to 45 days that are levered to a really big trend, whether it's biotech, whether it's augmented reality, these really big trends in the market that are wonderful tailwinds that as they announce news, more and more investors are going to pay attention to. And it's really focused on finding these opportunities while they're still small, before the big institutions get in or before companies like the big tech companies acquire them. Some of the classic trades in the past, if everyone remembers when the first fingerprint reader came out in the iPhone, that hardware was made by a company called Authentic. It was a recommendation I made and invested in at about $2 a share, and Apple bought them out for just under $8 a share. So we're looking to find those companies that have something that they're either going to take over the market or they're going to be acquired because they're just too strategically important to the bigs in the market.
That makes a lot of sense. So when you're talking about a catalyst, are you talking about a future event that's coming or an event that already happened?
A future event that's coming, right? So we want something that's going to be, like I said, it's a new product launch, a new contract with a big customer, a blue chip tech company, earnings report, anything that's going to put more people interest and visibility on that stock that's going to drive more buying into it.
Okay, so for example, if we talk about an earnings report, you're doing research and you're believing that there's going to be a positive earnings report, and that's going to be the catalyst. So you'll get in beforehand in anticipation that this earnings is going to drive price.
Yes, and a lot of times in these smaller microcap names, it's not so much the huge revenue beats and that they're milestone driven. They have a big development milestone they're going to hit. So it could be a multi-million-dollar payout on the milestones. It could be a new customer that they're going to reveal. So yeah, I'm not afraid, depending on where the price is at and what the stock's done ahead of earnings, to get in. That is a great catalyst, and it's it's one that comes every 90 days essentially. We're going into the next earnings reporting season. All the big companies will start reporting at the end of October, but small and microcap companies have 45 days to report. So really those first 2 weeks of November are prime trading opportunity in that market.
Now, what is the name of this product that you're going to be releasing, of the actual newsletter itself?
Yeah, it's actually called Microcap Advantage. So what we've done is we've gone back and anyone that signs up, you'll get all the research that backs it up. And we've looked at the best performing stocks over time, and consistently it's microcaps. The smaller, the better, and even a small allocation to them. We show this in one of our reports, is that even a 2 to 3% allocation to microcaps can meaningfully impact your bottom line and your net worth, just because of how much larger the gains are more consistently over time. So that's it. We focus exclusively on companies that are under 500 million in market cap. The sweet spot is really the 30 to 50 million when we get involved. And then as they cross that 500 million market cap, we move on. I mean, we reinvest at a lower price. It's, we want to buy low and sell high like everyone does. And that's kind of how we maneuver that.
Now, when you're looking for these hidden gems, it seems to me that these companies are pretty much exceptions and not the rule, that they're more rare, which makes them better investments. How do you go about finding these catalysts and these great microcap companies?
Yeah, so I think I'm unique. There's not many people do this. I look at patent filing activity. So I'm looking for, what is the big trend right now? If it's augmented reality, I'm going to see a big uptick in patent filings from the likes of Apple and Facebook and Google. And then what I do is I go bottom up from there and say, hey, who are the small cap companies, microcap companies that are filing a bunch of patents here too? Because those guys are going to have, if they have the right technology, they're going to be needed by the big players. So I use that as a unique identifier. The other thing is it's just a lot of research. Like we talked earlier about, don't ever take a company off your screen. There's some companies I'm involved with now that I started researching 2 to 3 years ago. Just the time wasn't right. It takes time for technology to develop and get to market. So I think a lot of it is being able to pay attention when no one else is paying attention, and then know when that moment comes. Like, hey, I've paid attention to 2-3 years of quarterly reports. I know these guys are really close. When otherwise other people are just reading the most recent quarterly report and say, hey, they're trying to get their bearings on it.
Now, I've heard, and I'm asking this question because I think probably a lot of people are thinking about this. I've heard that microcaps and smaller companies that aren't really profitable yet are usually a very high risk. And a lot of times you'll see people promoting them, and they're not really doing that because they have a lot of faith in the company, but they're just trying to pump it, right?
Yeah.
Because there's a lot of junk out there. So what would you say to somebody who's like really kind of skeptical and they're like, oh man, this is just another pump and dump situation?
Yeah. Stay skeptical. No, like I'm always skeptical too. So I'd say two things. One, there are a lot of just, bad actors out there. There's tons of microcap stocks. I mean, there's literally 4,000 to 5,000 of them on the exchanges. You can easily weed out a lot of the junk by focusing on ones that trade on a major exchange. So NASDAQ or NYSE, right? So that gets rid of all this bulletin board nonsense that tend to be the penny stocks that get pumped and dumped all the time. That's the first thing I do, is all major listings. And then the other thing is, like, I would tell you, when you read a piece of research, read the fine print. And I will not get involved if they're paying for someone to write about it. Like, then that means exactly like, hey, look, they may be paying for visibility, but it really doesn't smell right. It's a pump and dump potentially, and I move on to another opportunity. But I would tell you that there are every big company started out as a small company, right? So there, for every large cap that's available, at one point in time they were a major listed NASDAQ stock that was trading for a low price and a low market cap. So there are plenty of opportunities out there, but there is a lot of junk, and you got to know how to avoid it with some just basic screens to get them off the screen real quickly.
So how long have you specifically been really focused on microcaps? When did you start noticing this opportunity?
Yeah, honestly, it's been since about 2003, 2004, when I was at Morgan Stanley. I had to do investment manager searches for every asset class, and what kept happening is the best performing managers over time, risk adjusted, absolute returns, were these small cap managers, small cap growth and micro cap growth managers. And that's when I just realized, like, look, this is where the most money is being made in the market. And I've just gravitated towards that. I also I was pre-med in undergrad. So I talked earlier about going where So I had a science background. So I just stuck to some of those sciences in the early days. So a lot of biotech investing, which people think is very risky, and it is, because it's there can be binary events on data. But yeah, I really started in 2003, 2004 because of the performance numbers that I saw. And then the more that you dig into it, even if you go to like small cap value, these companies that are nice businesses producing consistent revenue and profits, like they dramatically outperform every other asset class too. So I just haven't found a better opportunity in the market. Every now and again we'll get a great opportunity in like a big cap like Apple, but those are fewer and far between than the opportunities in the microcap land.
Right, and there's the opportunity. It really is unlimited upside, which is the key. So, so with that, what is your risk management? I realized that earlier you said you're only going to use 10 or 20% of your portfolio for that. But what type of risk management are you using for each individual position?
Yeah, so I don't ever advocate cherry picking. I don't advocate putting a ton of money in one stock and then a little bit in the others. I advocate position sizing evenly across them. So if someone's new to a research service, I mean, even if it's not mine, I would say, look, don't try and buy them all at once. Just kind of start entering positions and use. For me, I usually start with a 2% position, and I'll build it up to maybe 4%. And then obviously as they appreciate, they become a bigger part of your portfolio. But I don't ever want one bad investment to just wipe me out, or to seriously set me back in my goals. By the same time, I want to make sure I'm spread across multiple investments, because sometimes the catalysts come sooner or a little bit later, and you can't time it, right? We can't just go and say, well, for the next 35 days, I'm going to invest in stock A. And then as soon as that catalyst hits, I'll move it to stock B. Does that happen sometimes? Yes. Is it consistent? No. So I want to be spread across multiple opportunities in a meaningful way.
How do you know when a trade is just not working out? Like, when do you decide to exit? Do you wait for a news catalyst to say, well, maybe I was wrong about this, the catalyst didn't play out the way I was thinking? Or do you wait for a certain profit level? Oh, I lost 10%, I'm done with this.
Yeah, in microcaps, they can be very volatile. So I don't have like a strict downside. Hey, I'm moving on if the price drops. It's really about the business. Did something change in the business? Did the catalyst get delayed? It's going to be something fundamental like that. It's not going to be just price activity, because a lot of times prices can get manipulated in the short term. If someone has to sell, if there's an institution that decides to move on and they dump the stock, in these smaller names, that can have an undue influence during the trading day, which is why part of my strategy and way I go about things is I have an active dialogue with management, with investor relations, and then a lot of times with large institutional investors in the stock. So I'll know if 300,000 shares got dumped, I can pick up the phone and find out that it's this, it's XYZ manager because they had a redemption. And then for me, that's an opportunity, right? Like it's the price is dropping on no real fundamental bad news. So yeah, I think the risk management side has to come in on the position sizing, not any absolute drop in percentage in the position itself.
That's a real big advantage to have that kind of information, and so it's really cool that you're sharing that in your newsletter.
Yeah.
As part of this promotion, I got access to your Microcap newsletter and was just looking at some of the past ones and even jumped on some of the current ones. And I was really impressed with what I saw, and I think it's a great opportunity for people to get into. So good night for very good work on that. And
Thanks.
I included a link in the YouTube description for people that are watching this on YouTube. And if you're listening to it on the podcast, there's going to be a link in the podcast as well for you guys to check it out and to see what Lou is working on. And I highly recommend that you give it a chance, you do the research, you see what he's offering, because I think that the opportunity here is really tremendous. And I like to go in and dig deep, just like Lou does when he's doing a research. But if I'm looking at a product or something, I like to do my research as well. And that's why I've got Lou on the show, and that's why I got access to his product. And so I'm really impressed with what I've seen. So really nice work. Any last thoughts you like to share about your newsletter, or about people that would be interested in checking it out?
Yeah, no, one, thank you for all that. I do appreciate when people dig in, and that's what I would encourage everyone else to do. Look, the timing might not be perfect, but it hurts you nothing to check out what we're talking about and some of the opportunities. And it's one of those areas of the market where I feel, as everyday investors, we actually have an advantage. It's not someplace that the big institutions can get involved in actively before us. So even Warren Buffett said that if he only invested in small and micro caps, he would crush the market every year, because it's just such an advantage. But he has too much money to move around in that market. So if nothing else, if the only takeaway people take from today is, I encourage you to check out what Rob and I are up to. It was great fun. You'll learn a lot. But also start digging into putting micro caps and small caps into your portfolio on a regular basis, because that really can change your future outcomes in investing.
Very nice. And yes, do your research and get some of those micro caps, manage your risk, do all the things that you need to do. But sounds like great advice, and I think it will yield some great results. So thanks for being on the show, Lou. Really appreciated having you. For everybody that's listening in, I highly recommend that you go check that link that I posted, and you're going to be able to see what he's got going on. And one other thing that just popped into my mind: are you guys doing some kind of event on October 14th?
Yeah, on October 14th, we're going to release we taped a big event just showing everyone how to use microcaps, how to take a small $500 and turn it into potentially over $1 million if you look at the right investment opportunity. So all the details, that event is going to be on October 14th. There's a lot of fun in there too with the DeLorean. I just encourage everyone to check it out. By clicking on that link, it'll automatically give you that information.
Awesome. All right. Well, thanks again. And until next time, we'll see you guys soon on the How to Trade It podcast.